Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Canada-U.S. Trade Minister Dominic LeBlanc says the trade agreement with the U.S. and Mexico should be renewed for 16 years. He made the point in a letter to his counterparts. LeBlanc in Washington today to meet with U.S. Representative Jameson Greer. Canada's official negotiations over its trade agreement with the U.S. have yet to begin. Prime Minister Mark Carney not using the word recession to describe the Canadian economy. He says his government is laying the foundations for a stronger, more independent, resilient economy. Carney's public comments were his first since the country went into a technical recession, 2 consecutive quarters of GDP decline. He says the slowdown is due to clear decisions by the government on limiting immigration and reducing spending. Home sales in Vancouver fell in May by nearly 4% compared to last year. Apartment sales dropped the most, weighing down the overall sales total, with a decrease in properties listed compared to last year. Greater Vancouver realtors say there is no obvious near-term catalyst to move the market. And the North American markets are again in record territory, with the TSX set to close above 35,000 for the first time. 400-point move up on the day, or 1.2%. Let's have a look south of the border. The S&P could also be a new record close. It's up just 11 points, but has been hitting record highs for some time. The Dow Jones up 271, or 0.5%, and the Nasdaq down this hour by 8 points. With stocks heading steadily higher at home and in the U.S., my next guest says there are lots of high-quality stocks to choose from with predictable revenue streams. Let's go to Barry Schwartz, Chief Investment Officer, Portfolio Manager at Baskin Wealth Management. Barry, good to see you.
Thanks for having me.
So we're looking at a possible new record close for the TSX above 35,000. The S&P also in that same area of a record close. What is behind, would you say, the confidence despite the war?
Well, we're in the gamification of the stock market right now, and there's a lot of FOMO going on, and a lot of people chasing stocks that have already moved up tremendously, and so it's a little bit concerning. On the flip side, of course, the earnings are there, and so it makes sense for the markets to go up. If you would have told me that we'd enter a technical recession, and yet here we are with the TSX at record highs, and it's just amazing, right? You would have told me that with the Iran war would have started, and the S&P 500 would be up 12%, gold would be down, and oil, it's at $90+, but quite honestly, it's not really reflective of what's going on. Oil should be a lot higher if the market was really, really concerned. $93 oil is it's punishing versus where we were, but in the context of history, it's not really that expensive. Adjusting for inflation, it's nothing.
Are you seeing any obvious reason for that? I was reading today that China is importing millions of barrels less than it used to, and that could be one of the reasons we're not seeing the price of oil move up as much as anticipated.
Yeah, I mean, that's a great point. I mean, anybody who's traveled to China lately will see that they've completely transformed the country to be focused on EVs, and that's great news. And so the more cars on the road using electric instead of gas obviously is going to be good for the world, and not necessarily so good for importing of oil and gas. That being said, of course, the rest of the world cannot move as fast or quickly as China, and so we're still seeing demand for oil and gas continue to increase, and we're also seeing, of course, it's getting harder to find good quality oil. And so obviously no one's complaining here. We're with $93 oil. The Canadian oil sands companies are making a mint here. And, I guess they would wish the natural gas prices would also follow higher, but that's obviously weather dependent and based on a lot of different factors.
Okay, let's get to the 3 huge IPOs expected this year. SpaceX planning to raise at least $75 billion US. Some say much more than that. Anthropic, OpenAI to follow. So where does the liquidity come from?
I have no idea, but it probably comes from people wanting to sell maybe the profitable names, the liquid names, the Magnificent Seven, to get into those kind of ideas. We're in a full-blown bull market, so this is what's going to happen. Companies are going to take advantage of the IPO window. We haven't had a great IPO window for a long time, and here it is. What should the regular investor do with their money? Obviously, if you want to take a flyer and you think you have knowledge about what's going to happen long-term with some of these companies, then go ahead. For our clients, I'm going to stay away. We can't buy companies that don't have a history of long-term profits, and certainly in an industry where things can change very, very quickly. This is reminiscent, Marilla, of the dot-com boom that ended obviously extremely painful. One difference, of course, is that the earnings are completely there, but those things can change on a dime. If you get a bunch of CEOs, a bunch of companies saying, you know what, this AI adoption is great for us to be able to make up emails, but it's not really adding to our long-term productivity, then that will stop. At some point in time, we're obviously going to see some kind of correction, some kind of nasty pullback. Can't tell you what it will be, whether it's a macro event, a credit event, or just simply people saying, wait a minute, why am I paying 200 times earnings for a company that has no profits? At that point in time, I think the market will return to looking for sensible investments, because there's a lot of companies out there that aren't in the hype right now, that have nothing to do with AI, where their businesses have been impacted by what-if scenarios that probably will never come into fruition. And so that's where I'm spending a lot of my time. It's frustrating, of course, because those stocks aren't going to work until they work, but I'm a long-term investor, very happy to buy high-quality names that are profitable today, making money. And what's going to happen is the same thing as the dot-com crisis. People will get destroyed on some of those names, and they'll never come back, and flock back to the high quality companies that are profitable and here to stay.
Okay, sensible is definitely out of style, as you know. Let's start with one of the profitable companies that you like right now, which is Visa. Why do you like it?
Visa is just an incredible business, in our opinion. Benefits from inflation, benefits from the world switching more from using cash to doing online shopping, to traveling. The company is guiding for double-digit growth. If you think the economy, like we do, is going to do fine going forward, then this is a very nice way to play it. Visa's up their share buyback. They're buying back a significant amount of stock. And we think for a company with very predictable revenue, trading at around low 20 times earnings for very strong growth is very attractive. I have rarely seen Visa and MasterCard trade at these valuations, given the type of growth. Will people be using stable coins going forward to make payments? God only knows. But at the moment, no one is. And Visa and MasterCard are still dominating their industry. And obviously, they are spending tons of money to participate in all these new technologies as well. So very attracted to that idea, and think that it's just not working right now because people are investing. I mean, the thing with Visa is you're not going to wake up and find like it's going to be like Marvell or Broadcom where it's going to go up 20% overnight. There's just no ability for that. But for boring long-term investors, this is the time to scoop up companies like that.
Okay, let me get to one more of your stock picks, because I can't get to the second one. But TMX Group is another one you like. Tell me about why.
Yeah, so all the exchanges today in the past few days have been destroyed as the U.S. is looking to make these prediction markets, allowing people to trade stocks and trade futures on them. The problem, of course, is that's just more gamification of the market and has nothing to do with investing. It's just complete gambling. I like to own stocks, own a share of a business. It's a real thing. Trading on prediction markets is not a real thing. It's baloney. But the TMX Group is down about 7% today on vibes. There's no news. There's no reason for the impact. This has been well known and well telegraphed that these prediction markets are going to continue to grow. Will it impact the possibility of people doing option trading and future trading on the TMX? Sure, that's a possibility, but I don't think it impacts whatsoever its long-term business. And we also have to keep in mind TMX is diversified into software and other recurring revenue areas and growing tremendously. So we really like this business, trading around 20 times earnings, growing at double digits, and we see it as a great quality but boring investment in today's market. All
right, Barry Schwartz, good to have you. So thanks for joining us.
Good to see you. Thanks, Marilla.
All right, coming up next, the Trade Minister, Dominic LeBlanc, in Washington, as we mentioned, to talk with U.S. representatives about the upcoming review for CUSMA. Back in a moment. The Canadian and U.S. trade representatives meeting today in Washington. And ahead of that, Dominic LeBlanc made it clear Canada recommends renewal of the CUSMA agreement for another 16 years. Let's bring in Drew Fagan on this, professor at the Munk School of Global Affairs and Public Policy. Thanks for joining us today.
Hi, Merle.
So this might be what Canada wants, but how likely is Ottawa to get that?
Well, it's possible, and it's what Mexico wants as well. I understand a similar letter was sent, and it's not a coincidence it's now because it's a month before the key date of July 1st, which is 6 years since CUSMA went into effect. I think it's likely these negotiations are going to go on for a while. I think there's a good chance there'll be a deal eventually, but it could go into 2027. If there's not a deal, the drop back is continuing negotiations, annual negotiations, until some sort of extension into the future from 2036 to 2042 or beyond does take effect.
Okay. Let me ask you what your thoughts are on the U.S. and Mexico already having talks and sit-downs without Canada in the room.
Yeah, this happened when we were negotiating CUSMA in 2018, 2019. It's not surprising the United States would have bilateral talks with both Mexico and Canada, the talks today now with Canada. I think it's fair to say that the Mexican administration in the eyes of the White House has been easier to deal with. They haven't been pushing back as hard. They've been kind of stylizing themselves a little bit to the changes in Washington, protectionist, nationalist, some might say nativist, which can be a problem, obviously, if you're talking about Mexicans in the United States. Canada less so, in part because of the rhetoric about annexation, the rhetoric from the president about Canada not really making anything the United States needs, which is obviously false. So we've sort of put up our dukes a little bit more. I think the speech from the Prime Minister last week in New York, where he stepped back a little bit and started talking a little bit more about the kind of deal that would benefit both the United States and Canada, was received warmly by the White House. So, now we get into this process from here.
Okay. Let's talk about likely demands from Washington. We've already heard about more U.S. content for automobiles. What else do you think is high on the priority list?
Well, supply management. The president almost fixates on our system of protections for dairy and poultry. It's a very small part of the market. It's a relatively small part of the agricultural sector, for which, we're big exporters, wheat and other goods, products. So he's looking at that. Of course, the United States protects its own agricultural workers. And as you mentioned, autos. There's a fundamental issue about autos that's hugely symbolically important. If you have a free trade zone, you can't really have rules that bias one of the three countries demanded for. And that's what the United States is doing. They tried it last time. They may succeed this time. It's interesting that the Canadian response is not, this is outside the zone of reasonable. It's more, well, that's kind of the status quo, but it does imbalance things unreasonably under the circumstances. Our opportunities in terms of doing more together with the United States really are in energy, and in particular in critical minerals. And I think that's what the Prime Minister was getting at last week when he said, in effect, we can do more together. That's critical minerals, especially in a context in which the country that controls the global critical minerals market is China.
All right, let me ask you about tariffs. Ottawa will obviously want relief from sector tariffs. Yesterday, the American president did drop some of those tariffs as far as percentages goes for some metal products. What do you think spurred that?
Well, it may be remarkably, a sign of good faith after, I think from a Canadian perspective, the last 18 months have been a series of steps pointing towards bad faith. I think one thing that we always have to keep in mind, and you emphasize this, is that most of the products going into the United States now are tariff-free. CUSMA, by and large, has been respected in technical terms. I'm not sure if the concept of free trade has been respected entirely in philosophical terms from the United States, but that's a good signal. The two sides are have fundamental differences with regard to whether the tariffs that exist now will be removed entirely. Part of Dominic LeBlanc's brief is to get those off: steel, aluminum, lumber. Yeah. Jameson Greer, his opposite, is saying they will continue. So we'll see.
Okay, Drew Fagan, got to leave it there, but appreciate your time. Mr. Fagan, professor at the Munk School of Global Affairs and Public Policy. Up next, shares of Marvell Technology soaring today. We'll find out why with our next guest. Stay tuned. Marvell Technology shares soaring today after NVIDIA CEO predicted the tech company will be the next business to hit $1 trillion valuation. We were joined by Felix Wang on this, global technology sector head at Hedgeye Risk Management, who talked about how realistic that prediction is.
It's about 237 billion market cap. So 3x, 4x what Jensen said. But look, I'm just curious what kind of gift basket Matt Murphy gave to Jensen for him to invite him on stage together, because this was a surprise. Marvell was going to have their own keynote. Matt Murphy was going to talk about interconnectivity. You know, this is the key bottleneck in data centers and how Marvell is a key pioneer of this technology. And Jensen just showed up, and and they had a lot of fun. I kept saying to investors, like, this $2 billion investment from NVIDIA cannot be understated. This is critical relationship in terms of trying to understand the next step in the frontier for AI data centers. This is a key relationship for Marvell. And as you can see by the stock today, it's soaring.
And I mean, numbers, it's a big number, but it's only about 1%. Of the valuation of the company. I mean, is that what makes it such a, I mean, is it just the name behind it that makes it such a key investment?
Well, you got to pay attention to every time Jensen opens his mouth and who his friends, partners, people he tout on the supply chain. So for him to step out and say, hey, Marvell is a key partner of us. They are the leader in interconnectivity. If you're looking into the future on how to reduce power consumption, improve density, you got to look at a company like Marvell. I thought it was interesting that he specifically mentioned AWS, right? And AWS and Marvell are very intertwined because Marvell is working on their ASIC chip, and that's one of the ASIC partners for AWS. So for him to directly say, hey, AWS, if you're really serious on being part of the NVIDIA ecosystem through what's known as NVLink Fusion, you got to consider Marvell. So I think that's also gaining some interest among investors today.
And from what you're seeing with Marvell, is it legit? I mean, is what he's saying, can they walk the walk?
I do think so. They are the key enabler of optical interconnect and SiPho tech stack. So what that means is that, we're right now, that's the key bottleneck in AI data centers. And CPO, which co-packaged optics, this is a buzzword that's been talked about a lot. And at Computex Taiwan right now, that's what everyone's really focused on. This buzzword means you extend that optical connectivity all the way into the chip package itself, by positioning it right next to the compute or switch units. And this is the way forward for meeting the performance requirements. As AI clusters get more and more dense, more and more massive, and the ability to move data efficiently get harder and harder, whether that's within or between data centers. So because of that logic, you gotta look at who are the leaders in this area. And Marvell has to be on the top, or close to the top.
And who's the competition for Marvell then?
Broadcom. So Broadcom, Avago, they usually Marvell is considered the much weaker sister to Avago, and for a variety of reasons. That's why it never gets as much attention as Broadcom and Avago. And now, and look at Avago now; they've surpassed the $1 trillion market cap. But the thing is, it's interesting enough. Even though Marvell may be inferior in some technologies, they still are able to generate more clients. They have Google on the CPU side, maybe on the NPU side. They have Maya with Microsoft. They have AWS on Trainium. So I think they're kind of left out of the picture here, but they are definitely relevant. And that's why I like it. It's our number 2 long, second highest conviction on our long list, just because I think it doesn't get as much respect as Avago. But Avago is also going to go up on these news from Jensen just because, again, people are focused on interconnectivity. That's a key bottleneck right now in AI data centers.
I guess there's no such thing as bad publicity, right?
Definitely. Any publicity from Jensen Huang, even if he coughs in your direction, it's positive.
and I mean, I'm looking at Broadcom's up as well today, so everybody's kind of taking a bit of a lift with this one.
Yeah, but right now, what we've been saying is all boats are lifted. But at some point, if the AI buzz or AI hype, if you say, kind of cools down, then we're going to have to look more into market share shifts. And, NVIDIA, Broadcom, Marvell, they're all interconnected. Arista is another name, Cisco. So these are all part of the networking interconnectivity optics ecosystem. And we think Marvell is a huge market share gainer. But right now, just because of how steep this bottleneck is with interconnects and communication, all boats are lifted.
And any indicators when it might ease that?
So we keep a close eye on 2 things. One is token growth. Token growth from LLMs, as you may have heard, from last night, Jensen keeps saying tokens are now profitable. Well, he's directly mentioning Anthropic because Anthropic was the first one to show a profitable quarter. But what about the rest of the LLM players, right? So we're keeping a close eye on token growth because token growth, a lot of people are saying it can grow exponentially from here as we transition from training to inference. But we have a good read. So when that growth rate steeply decelerates, maybe we're entering into another sort of part of the AI cycle, and maybe we need to take a breather. But we're not there yet, I would say.
Felix Wang, Global Technology Sector Head at Hedgeye Risk Management. Up next, closing bells. We could be hitting record territory again for the TSX, the S&P, as well as the NASDAQ. We'll give you the closing numbers, end of day, in just a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, WSFS Financial Corporation ringing the bell. In New York, it's Victoria's Secret doing the honors. And for Toronto, it's Pride at Work Canada to close the market and celebrate Pride Month. We're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. So it is a record close for the TSX. It moved up 434 points today, or 1.25%, up above 35,169. We'll have more on that in a moment. The S&P also hit another record. It's at 7,610 today, beating the record just yesterday, only moving up 10 points, but enough to do the job. And then the NASDAQ Composite also moved up 7 points today. The NASDAQ was at 2786, so it did scrape a new record high today at 2793. Let's get to the movers in Toronto. We're going to start here with Celestica, or Constellation Software. Sorry, I think we're supposed to have the Celestica one up there. Let's take a look at Celestica there. It is up almost 11%, or 64.58, taking the stock price to 652.82. There's renewed optimism in AI in that trade. Energy Fuels, another mover on the day. It gained 10.9% or $2.65 a share. It helped to lift the energy sector into the top performers of the day. Discovery Silver up today almost 10.8%, up 87 cents to $8.94. Let's move to the red. Some of the software stocks in the U.S. are gaining, but in Toronto, not so much. Thomson Reuters down over 8%, losing $10.45 a share. Shopify, always volatile, also considered sort of an AI software stock, down 5.7% or $9.72 a share to $161.95. And then the TMX Group also had a down day, dropping 6.7% to $47.80 a share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to look through some of the movers. Stephanie, talk to me about BRP, a gainer today on the TSX, but it's been dealing with tariffs on metals. So what changed?
Yeah, that's right, Marilla. So BRP is having an up day. It gained by as much or by over 8% at its highest point today, which was its biggest intraday boost in over a month. And it was enough to bring the stock price back to where it was in mid-April. So the recreational vehicle makers getting a bit of a tailwind today based on some tariff news that we got from last night, where U.S. President Donald Trump said that he would be easing or cutting tariffs on agricultural equipment to 15% from 25% as he was adjusting some tariffs on metals more broadly. So BRP is known for making Ski-Doos and other cottage country recreational vehicles, but it also has some vehicles that cater to the farming and ranching space, most notably with its Can-Am segment. So speaking of that business there, Can-Am, they also announced that they're launching this mobile app called BRP Go. It's for electric motorcycles and three-wheel vehicles that allows users to communicate with each other and locate each other on their display screens on their vehicles. So it shows that they're actually still investing in this space. So shares of BRP on a year-to-date basis, as you mentioned, it's very much embroiled in this whole tariff story. They are still struggling on a year-to-date basis, down by about 13% last time I checked. And most of that was based on a setback in April when they cut their guidance because of the uncertainty around the U.S. tariff issue. And that led to a few analysts actually cutting the recommendations on BRP because of this uncertainty. So today, it's getting a bit of a break on the tariff front, at least, Marilla.
Okay, let's get to that record close for the TSX today. I know energy was part of that, but what played into this?
Yeah, so pretty good day for Canadian stocks. They broke through a new record high, but most importantly, they broke past that 35,000-point mark for the first time ever. And like you mentioned, it was a lot of energy stocks doing the heavy lifting there. So the entire index gained by over 1% at its highest point, fueled by energy names and financial names. On the energy side, it was mostly uranium names like Energy Fuels and NextGen Energy doing the heavy lifting. They're among the top performers after major uranium producer Urenco USA said that it would boost its capacity in its U.S. or its American enrichment facilities to offset a ban in uranium over in Russia. So uranium names are also just gaining because of the AI exuberance play. Of course, uranium is seen as the go-to energy for data centers, which are crucial infrastructure to AI. Just in general. And financials were also the second best performing sector on the TSX today, with lenders and insurance firms seeing some really good gains there coming off the back of strong Canadian earnings, as per a strategist I spoke to earlier today. And then, of course, you've got Canadian tech darling Celestica topping the gains and adding the most amount of points to the TSX as the electronic component manufacturers really benefiting from that resurgence in the AI play. So traders are still looking for clues on the U.S. trade front, some easing on tariffs there, and of course, some sort of sign that the conflict in the Middle East will be ending a conclusion, which will hopefully help some resource prices for the TSX, Marilla.
All right, Stephanie Hughes with the latest out of Toronto. Thanks for that. Up next, what does Alphabet's $80 billion stock sale mean for the markets? We'll tell you in just a moment. We had some movers in Toronto. Let's get to movers south of the border today. We're going to have Bloomberg's Avalon Purnell, who joins us now. Avalon, what has been driving the rallies today in Hewlett-Packard?
Yes, Hewlett-Packard Enterprises surged 19% to hit a record high at the close. And that's after the tech company's full-year profit forecast really topped estimates. They've been seeing some massive growth in demand for servers and networking, and they're really expecting that to continue throughout next year as well. And they have AI, as many of these companies do, to thank for that. Also worth noting that the bar was really high, given that its competitor Dell also reported blowout results just last week. But as we saw from this performance today, it definitely rose to the occasion.
Okay, let's also get to a blowout day for Victoria's Secret. Stock was up almost 50% last I looked. I mean, is that just on solid earnings?
You're absolutely right. Yeah, it actually ended the day at a record high, and that's after reporting net sales for the first quarter that surpassed expectations. It also boosted its full year guidance. And Jefferies is also writing that the company remains very well positioned, which will obviously be welcome news to investors who have been questioning the last couple of years. How exactly is Victoria's Secret's turnaround going to look like? It seems like we have a better idea under this new CEO that things seem to be heading in the right direction.
All right, let's get to Fulcrum Therapeutics. They released an update on their sickle cell program. What happened there?
Yes, not as great news there. They sank about 50% today to close out their worst one-day drop since 2024. And that's after the biotech said it is discontinuing its sickle cell program. That was basically the only thing that this biotech had left. And we already knew that they had failed the clinical trial earlier this year. However, the update did lead to a slew of downgrades across the street as analysts question, what exactly does the future look like for this company without anything left really to create that shareholder value? That's actually what H.C. Wainwright had in a note saying that the question is no longer if they will pursue sickle cell disease, but if they can create any value at all.
Okay, that's a down day for them. Avalon Purnell with the latest. Thanks for that. Alphabet dropped today on plans to raise $80 billion from stock sales. So what does that indicate about the markets, which saw the S&P, of course, hit another record close? Owen Lamont joins us. He's Senior Vice President, Portfolio Manager at Acadian Asset Management. Thanks for your time.
Good to be here.
What do you think about Alphabet's plan to raise $80 billion? What does it take to investors when companies are selling rather than buying back?
Well, let me give you the background, which is for the past few years, U.S. firms have been repurchasing equity. They haven't been issuing, haven't been selling equity. They've been buying equity. So if you look at the dollar weighted across all firms, they're buying back like 1 or 2% of the shares for years. So if you see a company like the news today that a big company is issuing equity, that could be a sign that firms are going to pivot from buying back equity to issuing equity. And I think firms are the smart money. And when you see them selling equity, that's because the equity is potentially overpriced, or at least not underpriced. When you see them buying equity, that means the equity is underpriced. So far, we haven't seen a lot of issuance in the U.S. stock market. And if we see companies stop repurchasing and starting issuing, especially big companies, that to me would be a sign that the market's overvalued or getting overvalued.
Okay. There are 3, of course, mega IPOs this year, SpaceX and Anthropic already filing. What would be the impact of these major Anthropic, OpenAI, and SpaceX going public? What would be the impact on the broader market?
Okay, 2 things. First is, the reason they're selling is because they think the market it's an attractive time for them to sell. So they wouldn't be selling if they thought that they wouldn't be getting a good price, that their prices weren't at least fair or possibly overvalued. So the first thing I would say is, when you see a big IPO, that is a sign that the market is expensive. Okay. Second thing is, how do you get from being an expensive market to a cheap market? You know, I'm an economist, and my favorite 2 words are supply and demand. So when you see these big IPOs, that is supply coming onto the market. And I think what we saw in 1999, when we saw stocks were really overpriced, we saw a ton of IPOs, and we saw a ton of big IPOs, we saw many small IPOs, we saw a ton of issuance from existing companies, and that was kind of how you solve the bubble, or how you drove the price down. So if we see a bunch of huge IPOs in the coming couple months, and we see a lot of other IPOs, follow-on IPOs, that is a sign that the market's overpriced. And it's also possibly supply coming online to drive prices down. You know, it doesn't mean that it's the market top, doesn't mean that it can't market can't keep going up for a couple of years. But to me, a huge wave of issuance would be a sign that the market's expensive is overvalued.
So you believe that the SpaceX IPO and other big ones are fundamentally misunderstood. Can you explain that?
Well, I think a lot of people have this idea that SpaceX, for example, is suddenly going to sell $2 trillion or $1.7 trillion, on one day in June, and that's not what's going to happen. What's going to happen is there is a small amount they're going to sell, maybe $75, $80 billion. That's going to happen if the IPO occurs in June. So it's a relatively small event in dollar terms. Of course, the SpaceX IPO, if it happens, is going to be an incredible spectacle, and I will be watching it. But in terms of dollars, it's not like a massive amount. The float is tiny compared to the market cap of the whole company.
So if you're an investor and you're sort of on the fence about whether or not to jump into one of these or try to anyway, what are you watching for on that first day or even that first week?
All right. Well, I don't want to give any investment advice, but what I'm going to be watching for on the first day, especially of SpaceX, is it a chaotic process? Is it an orderly process? And does the price go up from the offer price to the close price? And we call that the pop, the first day pop from the offer to the close. And typically a successful IPO is going to go up 20, 30, 40% from the first day they design it that way. And in an unsuccessful IPO, it would embarrassingly be flat or go down. And in an incredible mind-bending bubble, it would double. It would go up 100% on the first day. So I'm going to be watching whether there seems to be an orderly process and people are upset or trades happening in an orderly fashion, and does it go up, and is it incredibly volatile in the first few days? And we have all kinds of reasons to think that, this is like an unprecedented situation. There are a lot of special features of the SpaceX IPO, and it could go very well, but it could go poorly.
Do you see, Owen, this batch of IPOs, which are going to be so big, setting off a wave of other IPOs?
Yeah, it could happen. And I think it's useful to compare the last big giant IPO, which was the Saudi Aramco IPO. And that was a huge IPO. It was like SpaceX. It was the largest IPO, but had a very small float. And that was really a one-off. It didn't trigger a huge wave of IPO. I don't think it really had any implications for the market as a whole. But if the SpaceX IPO goes well, and then there's the Anthropic IPO or other IPOs, and then we see a ton of other companies coming public, that to me would be a sign that we're really in a bubble, or we're really in a new world. Because the U.S. stock market has really been in an IPO drought for 2 or 3 years. And this SpaceX IPO could really change the whole tone of the market. It could potentially make me think we're really in a bubble, or if it doesn't go well and people reject it and there's no more IPOs, that would make me think that the market's not bubbling. Okay,
so that being said, is there enough liquidity for this IPO flooding we're having?
Okay, well, as I mentioned, people are only talking about 75 or $80 billion. So that's not a large number. That's like 4 days of Tesla's volume or something. I think the issue, rather than calling it liquidity, I would call the issue is going to be chaos and confusion. When on the day the index funds buy, are they going to drive up the price? So I think that the thing I would be looking at is volatility and lack of stability. That's what I would think about. All the signs are that there's going to be tons of demand for this IPO. So that to me sets up a situation where you could see real volatility as there's uncertainty about how much demand there is. It is true that it's the largest IPO. $80 billion is a large number, and people are going to have to figure out what the price is. We call it price discovery, and I'm not sure price discovery is necessarily going to happen in the first day. It might take weeks or months before the price settles down.
Owen Lamont, good to have you, sir. Thanks for joining us on The Close today.
My pleasure.
Coming up, why Bitcoin's facing downward pressure when we come back. Bitcoin under more pressure, slipping below 70,000 for the first time in 2 months. Let's take a closer look at what's driving the move and whether leveraged investors are positioning for a rebound. We heard from Michael Rapkin, Global Head of Business Development at DV Chain.
Everybody wants to know what's driving the slide down. So obviously, Bitcoin's down year over year around 34%. Ethereum's down year over year close to 22%. And I have a couple of reasons for the recent sell-off here. So firstly, MicroStrategy did its first sale. So they're the largest institutional holder of Bitcoin. They disclosed in an SEC filing that they sold 32 Bitcoin to fund dividend payouts. So this broke really a longstanding never sell policy and kind of spooked the market. Second reason is capital rotation to tech. So while Bitcoin has struggled, traditional U.S. stock markets reach record highs. And so investors have rotated capital into AI and chip stocks, really siphoning attention and investment away from digital assets. And then ETF flows and geopolitical tensions. So sustained institutional withdrawals from some of the biggest digital asset ETFs combined with the kind of a risk-off market environment, which is driven by renewed geopolitical tensions in the Middle East, really increased selling pressure. And then one of the last reasons I have here is long liquidations and fear, right? So the broader crypto market sentiment quickly soured with the crypto fear index really dropping into fear, leading into a wave of forced liquidations. And then, saying all that, Bitcoin continues to trade well below its 2025 highs, but the broader story still remains being institutional adoption. And what we're seeing is really a much more mature market than previous cycles.
You mentioned Bitcoin ETF flows as well, and I wanted to dig into that a little deeper. Like, what story do you think that's telling us right now in terms of what you're seeing?
I think that there's fear in the market. And as I mentioned, we are in a risk-off market, especially in speculative assets, which Bitcoin is still viewed as that, right? Generally. So to say that the buyer base significantly has changed over the last couple of years, versus 3 years ago. We've seen a lot of ETFs come to the market, asset managers, family offices, pubcos, corporate treasuries, and really unlike prior cycles, which were really, in my opinion, heavily retail driven, institutional participation does continue to increase. But again, it's a short-term fear, but the long play is still intact. And the key question is really not if Bitcoin survives. The key question is how large of an allocation Bitcoin ultimately becomes with institutional portfolios as time progresses. So really the debate has shifted from whether institutions should own Bitcoin to how much Bitcoin they should own. And really the biggest difference today versus previous cycles is that institutional adoption and regulatory clarity are moving in the same direction, which is creating a much stronger foundation for the asset class. And really, to answer your question directly, Lindsay, Bitcoin is still a risk asset. It trades within the broader macro environment. Higher rates, uncertainty around growth, and broader risk-off sentiment can impact Bitcoin in the short term, even though while the long-term adoption story remains intact.
Is Bitcoin the only cryptocurrency, though, that's facing these headwinds right now?
No, Bitcoin is typically the leader. So if Bitcoin's down, you'll see the rest of the market down. Ethereum, which is the second largest cryptocurrency by market cap, it's faced downwinds as well. And so is the rest of the market. But, Bitcoin continues to lead the market. The bigger story here is that confidence is returning across the broader digital asset ecosystem outside of the last 7 days, as institutional adoption grows and really as we get more regulatory clarity, specifically the Clarity Act.
I wanted to ask you about the Clarity Act. That will move Bitcoin to the Commodity Futures Trading Commission. Tell us more about the Clarity Act and what that means, what that will do for Bitcoin.
Yeah, for sure. So this may be the most important development of the year. So for years, the industry wasn't really asking for less regulation. It was asking for a clear regulation. And so markets reward certainty. And so the more clarity institutions receive around custody, trading, settlement, token classifications, the easier it really becomes for traditional firms to participate. And so, generally markets don't fear regulation, markets fear uncertainty. And so one of the biggest regulatory stories, as I mentioned, is the Clarity Act. And the Clarity Act is essentially about defining the rules of the road for digital assets. And so for years, we've wanted that as an industry. And really the bill aims to establish clear oversight between the SEC and CFTC and reduce regulatory uncertainty. That's more important because capital tends to move towards markets where the rules are clearly defined. And for years, this has been one of the biggest questions facing our industry.
What's your outlook for digital assets for the remainder of 2026?
So there's a couple of key takeaways that I have. One being hoping that, the Clarity Act advances. We're still waiting for the Senate committee to vote on it. It looks like it will pass, but you never know. I think stablecoin adoption continues to grow. I think that's probably the biggest story of the year. Traditional financial institutions continue expanding stablecoin initiatives as regulatory frameworks improve. And so, like a lot of institutions recently expanded access to stablecoin offering to millions of customers. And stablecoins are really used in many different ways: cross-border payments, faster settlement, etc. And I think what we're seeing right now is digital assets being integrated into the traditional financial system. So we're seeing crypto rails such as perpetual swaps, which have been a standard instrument on offshore crypto exchanges for years. Venues like Hyperliquid have opened up the market to 24/7 decentralized access to commodities, energies, equities, and even some pre-IPO perps like SpaceX, for example. And so we've seen that token do quite well despite Bitcoin's volatility. And even at DV Chain, despite being primarily a crypto desk, we are seeing these on-chain commodities, energies, equities, like I mentioned, start to take a serious share of the volume.
Michael Rapkin, Global Head of Business Development, DV Chain. Coming up, Victoria's Secret surges after unveiling a first quarter beat. Back in a moment. Lingerie maker Victoria's Secret beat estimates on first quarter earnings and revenue. The stock just took off. It was up 47% by end of day. Let's go to Simeon Siegel, the Senior Managing Director, Consumer Equity Research Analyst at Guggenheim Securities. Thanks for joining us today.
Good to see you.
So what's the whole story behind the surge? Is it about more than just the earnings beat?
It's not a bad number, right? 50% in a day. So listen, I think that obviously there's sentiment, there's expectations, that's the market. But they put up a really good result. I think this was a top line and a margin. And right now in retail, there's a lot of top line. There's not a lot of margin. And so if you can show that you're actually driving the business because of idiosyncratic reasons, not just because tariffs are lifting price, you're going to get rewarded. 50% is a big reward, but I think they're showing really good results.
Okay, so let's talk a little bit about those results, because we know right now that consumers, especially in the U.S., the sentiment is weak. There's not a lot of confidence there. They're also dealing with having to pay more for gas or energy overall. That's going to eat into their wallet. So why is this company, which makes what you call products that would be more discretionary, doing so well?
Yeah, it's an interesting dynamic. So we've actually been looking into this. Discretionary, you hear discretionary and you think, oh, you're going to pull back really quickly and you're going to get the first trade down. Ironically or not, counterintuitively or not, the discretionary items are actually seeing really nice revenue acceleration, and that's across the board. And so Victoria's Secret posted 15% revenue growth. That's huge. But my average group, we're seeing 7, 8, 9%. You're seeing really strong growth. And so I'm wondering, and my team's doing some work on this, trying to figure out, do you trade down for a quart of milk much faster than you trade down for a sweater? It sounds like the answer would be no, but the reality, what we're seeing is yes. And so I think there's just been this collective move as tariffs raised price across the group. When people decide to spend, they are spending. And listen, I can say, healthily or not, the U.S. consumer is overly resilient. I can say that because we can see the numbers. They are spending.
Okay, so it's not an or situation. I'm not going to get this because I have to get this. It's I'm going to trade down on this so I can still get this.
Listen, it could be, and again, that's why I say, like, I don't look at consumer staples. I'm not talking about cereal and milk and things that and gas with frequency that you need. I think people absolutely, there's no question you're feeling pressure at the pump. That's a reality. We're just not seeing it when it comes to discretionary.
Okay, so let's talk about what has been doing well product-wise for them, because I know the CEO has been trying to push this around. They're trying to attract younger customers. They've been focusing in more on very specific products. So what has done well for them?
When you think of what Victoria's Secret sells, that's what's doing well. And so what is interesting, and so Hillary Super's been there for a little over a year now. She's assembled her team. They've put the story in place. And what they're doing, I think, is returning to what Victoria's Secret stood for in the first place. And so she started by acknowledging that Pink, the sister brand, had seen its revenues collapse. And so that was the first area. And so focusing on revitalizing that story, but then moving on to the traditional, when you think about intimates and lingerie within the Victoria's Secret side as well, That's what you're seeing. To generate 15% revenue growth and then see that continue, it can't be one specific area. There was this interesting conversation last week, Gap reported, talking about dresses with Old Navy. These big businesses have to sell everything. And so I think when you see a result like this, they're really showing that it's the story that's working and the products that they offer are following.
Okay, they have activist investors. I'm wondering whether those investors are sort of sidelined by them doing so well, or how's that dynamic changing?
Are you giving them plural investors now, where we're adding many activists
well,
to this?
We know there's one main activist investor. So I'm wondering sort of how that's working or if that's changing.
Yeah, so it's interesting, right? Because you don't normally see an activist investor driving a campaign at the same time you see a stock up 50% because of fundamental strength. And so there's this interesting conversation to be had of, did they just give the most vocal conversation that they needed to do vis-a-vis this campaign? Because obviously until today, these results weren't out there. So I'm not going to pretend that I know. It's above my pay grade. But I think if you're sitting there in the C-suite or in the corner office or on the board or whatever, if you're in that corporate office, probably the greatest thing you want to do is exactly what you just did. And so the question becomes, what is the campaign, right? The goal, what are you trying to change? What are you trying to affect? And it should be either bringing the stock up and or bringing the performance up. And they just did both today. And so I wonder where that goes after today.
I was going to say, how sustainable is it?
It's a good question. So far, they're sustaining it. There's going to be this, you and I are going to be talking over the next 6 months. We're going to have this fascinating recurring conversation. We're starting in about a month. Everyone's going to be saying what happens in the back half of this year, because starting of Q3 of last year, everything started going great, right? I told you there's been this retail revenue acceleration because of tariffs. That started after the summer. That started in the third quarter, which means everyone's going to have to lap that. And then we're going to find out, was this a circumstance of the market or was it idiosyncratic? You're seeing companies, I think the thing you're going to want to watch the most is who benefited from price versus who's actually selling more units, who's actually bringing more people in. And so what's interesting is if you think about Victoria's Secret telling you they're bringing in a whole new group of customers, Ross Stores last week telling you they're driving their revenue from a whole new group of customers, arguably both participating in the low end of the kind of the K-shaped economy that people keep talking about. That's very different than just benefiting from a tariff-induced price hike. And so I think as we go through, so far, Q1 obviously was incredibly strong, building off of momentum they had, but they're saying it's continuing into the second quarter. The third quarter is when rubber's going to hit the road for a lot of the retail environment. And that's when we're going to find out who's doing something special versus who is just participating in this price lift. I would look to traffic. I would look to who's selling more things more than who's getting the price to try and figure out who those winners are going to be.
Simeon Siegel is the Senior Managing Director, Guggenheim Securities. Thanks for your time.
Great to see you.
When we come back, Michael's CEO betting more shoppers will head back into stores, but can that strategy drive growth? We're back in a moment. At a time when most retailers are doubling down on e-commerce, Michael's is taking a different approach. We sat down with the CEO, David Boone.
Our business, we've essentially refashioned or repurposed the business to be the center of creativity and celebration in every community in North America. And those words are very specific for us. And if you think about our business, we've always been in the creativity business. You started saying arts and crafts. What people don't know is we're also part of the celebration business. We sell a lot of seasonal decor. We help people celebrate the holidays. So it was very natural for us to go into party supplies, helium balloons, and all the related products that help people celebrate life's moments.
And how has that been going? How has the transition?
Been fantastic. So, we've attracted millions of new customers across our chain as a result of the expansion into party and the expansion into fabrics and other crafts as a result of the exit of Joanne from the market, particularly in the US, but we're seeing it in Canada as well. And so it's been a really good time for us to have expanded into those markets and serve those customers. And
what were some of the challenges? I mean, one that comes to mind, helium.
Yes.
Can you get helium? But what are some of the real challenges of bringing those two together?
Well, so the big challenge is we needed to go fast. And so as an organization, we moved very quickly to build a party shop by Michael's in every store in North America and a knit and sew shop. And then build up the network and productivity and the supply, in particular in helium, And that was a lot of effort for our organization to set that up. And yes, we have helium, and yes, we can provide balloons, and we've got a great network of suppliers across North America.
And from the expense side, with doing all that and implementing it, how did it come together?
So it's great. We're a business that's owned by Apollo, and they were happy to invest in these opportunities and really drive this business. And certainly consumers responded. So it was a good investment. We added nearly 1 million hours of labor to our stores in 2025. So it's been really a great story for Michaels.
All right. And the other side of this, the DIY, do-yourself, bringing together people into the stores to kind of stay in the stores, isn't it?
Well, there's this amazing trend happening right now, I'd say globally, but certainly in North America, where a trend towards authenticity, hands-on creativity, in-person celebration. Things like, if you look at our website, things like analog crafts, searches are up 130%. Girls' Night crafting, it's up 250%. And so what we are doing is leaning into that, not only from an assortment and point of view, but also creating events in our stores. And so every weekend, there's events in our stores. If you were in our stores during the Christmas or the holiday season, you could have come in and painted ornaments and take them down. We're adding services that allow people to personalize things and send them to their loved ones. As an example, a personalized Christmas ornament. So lots of things happening to drive engagement with our customers and lean into that trend.
What is driving that, do you think? Because we were talking about it off air. I saw about film. Young people especially are going out to the theater again.
Yes.
Is it people who have just been 5 years of the pandemic, 6 years ago since the pandemic, and it dragged on? Is it people just want to get out again?
I think there's a bit of that. I also think there's a bit of inundation of screen time. And, our studies and our stats would say, particularly young people, something like 50% of them are looking to reduce screen time. Like that's what they're saying they're doing. And looking for outlets, whether it's going to the theater, and in our case, doing hands-on creative crafts. They're looking to get together with friends. They're looking to engage with others in a different way. And there isn't a place that I don't go today, and I say I work for Michaels, I generally don't say what I do, and they tell me about something they have done creatively with friends, whether it's painting a mug or doing an event together. So
it creates the memories. And how are you keeping people coming back? What are you doing to, they've done it once, do they want to do it again? Or how are you?
So certainly one thing we do is we have a pretty strong loyalty and reward program that we've just rolled out across Canada. We have it across North America. So that's just a very mechanical way to connect to our customers. But secondarily is mostly staying on trend. So, we develop 24,000 different products a year and roll them out across our network. And so ensuring that we have the next greatest thing combined with in-store events and services really is the model that's working for Michaels.
And you mentioned people wanting to get away from the screens. Are you still working from the online side too, though? How are you combining that without getting too
far? Well, look, so it's very interesting. Our e-commerce business is growing, quite dramatically. So people are still shopping online, but our store business is growing as well. One of the paradoxes of this kind of analog hobby movement is, although people are craving this in time, a lot of what they're finding and they're discovering online, like in social media. They're following an influencer who has something they create, whether it's a keyboard or how they decorate their house for a party or what they do for their kids' parties or some new version of knitting. There's a lot of discovery online in social media that then drives customers into physical channels.
And do you see expanding? You mentioned at home. Do you see Michaels expanding into maybe at-home parties and things like that?
I think it's in the realm of possibilities. Right now, we're going to focus on updating the store experience, and we're very focused on that.
And partnerships with this, it seems like there's opportunities for that. Are you exploring something like that?
Well, we do partnerships and collaboration. So some interesting ones is we just launched a set of products with a designer. A great collaboration, and his name is Jonathan Adler, and that's allowed us to create new and unique products, both do-it-yourself creative kits, in addition to home decor items. So we do partnerships in that space. You see us do a lot of interesting things in birthday parties. So one of the interesting things is for families, our birthday party business in-store is growing 5x, and that is people wanting to show up, do hands-on crafts with their kids and with their families. And we have tons of partners through Disney licenses that people are fully engaged. So there's lots of opportunity for Michaels to partner.
All right, and with this, what's been the biggest lesson as a CEO of doing this on such a scale? I mean, this is a large scale. It's not one little store you're doing it in. What's been the biggest lesson for you?
The biggest lesson for us as a team has been to be very focused on the customer and very focused around prioritization so we can move fast and serve customers who need to be served.
David Abuna, CEO of Michaels. Hot Picks coming up next. We zero in on plays in industrials. Back in a moment. Time now for Hot Picks, and we are focusing today on industrials. We were joined by Evelyn Chow, Managing Director at Neuberger Berman, and we kick things off with her thoughts on the sector.
Tech is actually not the only place where AI matters. And in fact, when you look at global industrial indices, some of the AI equipment and electrical equipment makers are the best performers in the index year to date. I think that is counterbalanced by also some cyclical uplift we're seeing in the sector. But there's a lot of opportunity to invest in some of the brick and mortar players within industrials that are building AI.
Right, because we've seen the AI investment story evolve this year into semiconductors. Do you see it evolving further into the kind of infrastructure story instead?
Absolutely. I mean, I think one of the names that I like best when I think about what are the major constraints facing data center buildouts today, it's actually how do you handle all this heat coming out of the data centers as chips get hotter and denser. So a name I really like is nVent Electric. The ticker is NVT. They've evolved from what has historically been a traditional industrial company about a decade ago into one of the leading ways to play liquid cooling, which is a technology that is involved now in about 15 to 30% of all AI deployments. And that number is meaningfully higher when you actually think about cluster deployments. I think one of the advantages of liquid cooling is that unlike air cooling, it can handle chips, especially in this new Vera Rubin generation, that are just getting hotter and hotter. And so liquid cooling actually is a very efficient way to transfer heat out of the data center. nVent is also doing that in a way where they're able to compound earnings 20% plus over a cycle, with organic growth driving that in the mid-teens or higher.
Another name you like is GE Vernova. So why has power become one of the biggest bottlenecks when it comes to AI growth?
Yeah, I think power has been kind of the debate du jour of what's happening in terms of the AI build-out. So some estimates I've seen suggest that there's somewhere like a 15 plus gigawatt requirement for increased power generation demand annually, a lot of that being driven by data centers. And so there's this massive supply-demand gap within power. GE Vernova stands out because it actually has greater than 25% of gas turbine market share globally. And gas is going to be one of the leading ways that we're going to get more power for more data centers. What's really compelling about GEV is it has this multi-year backlog, $200 billion by 2027. That's going to give it a ton of visibility into its growth profile. It's getting that growth at a very high ASP, which is very mix accretive for the company. And it's also compounding that growth with an extremely strong services engine that itself is getting higher pricing as well. So it's actually, the stock has taken a bit of a step back since its April earnings report. There have been some concerns around what could happen to capacity in the market as some of its key peers are planning to add capacity in 2029 plus. So I see this opportunity with this relative pullback as quite compelling for a name like GEV.
You've also highlighted contemporary Amperex technology, and this is about energy storage. So tell us how that kind of fits into the AI landscape and narrative going forward.
Sure. So, Lindsay, if nVent is solving heat, GEV is solving power, then CATL is solving energy storage, which is one of the key technologies that's driving some of the deployments in AI data centers today. I think one of the things about CATL that's also very interesting is it shows that the data center opportunity isn't just constrained to North America, since this is a Shenzhen-listed company, historically an EV battery and battery materials maker that has carved out a leading position in the integrated full stack AI DC energy storage system ecosystem. Try to say that 10 times fast. One of the things I really like about CATL is not only has it demonstrated leadership in energy storage, but it's also demonstrating the ability to access the U.S. market through its tie-up with Ford. And it's also pioneering innovating technology such as sodium-ion batteries that will become a medium-term, very important solution for storage.
It's interesting because we've been hearing a lot of concerns about grid constraints across North America moving forward as well. Like, does power scarcity become one of the defining kind of investment themes of the next decade, do you think?
I think that's a really trenchant observation because, we're already starting to see that gap between cup and lip of how much power we're able to produce today, how much power we're able to get at multiple points in the day, and how much power data centers actually need. And so, you've seen across the ecosystem, transformer investment is up like 120% over the last 5 years, and that capacity is still not sufficient. We're seeing lots of interconnection increases. We're seeing, names like GE Vernova, which are having to step into kind of the breach here and try to figure out how do we get so much power into AIDCs because, they're dramatically reshaping the energy demand landscape in a way where it's actually growing after many years of very flattish demand growth.
So you've highlighted three names here that are within the same sphere, but they have different stories, and they're going to be helping with different things when it comes to the AI build-out. Just quickly, is there any headwinds that any three of these names are going to be facing?
I think a very key industry headwind at this point is actually the notion of labor availability. It seems so counterintuitive that investing in this cutting-edge AI technology should ultimately be constrained by something as basic as labor. But what we've been hearing is, when you talk to E&C companies that are the companies actually constructing the data centers, there could be a real labor availability gap, and this is quite skilled labor, especially as we look to end of decade. So, I think that's one of, frankly, the biggest constraints on the ability of some of these power and liquid cooling names to actually continue to accelerate, which is just the gating factor of what's happening when you simply can't build data centers fast enough.
Evelyn Chow, Managing Director, Neuberger Berman. Trade talks front and center with the minister leading the file, Dominic LeBlanc, in Washington today. Now, ahead of the meeting, he issued a letter to the U.S. and Mexico calling for a lengthy renewal of the Continental Trade Agreement. CTV's Abigail Beeman is in Washington.
Minister, what are the goals of this meeting?
The goals of this meeting is to be able to tell you how well it's gone when we finish at 5 o'clock this afternoon.
The Canada-U.S. trade minister and chief negotiator in Washington to talk with the top U.S. trade rep, Jameson Greer. Dominic LeBlanc issued a letter to the U.S. and Mexico officially stating Canada's recommendation for a 16-year renewal of the Canada-U.S.-Mexico Free Trade Agreement. While a delegation from Manitoba was also here Tuesday, separately meeting with other U.S. trade officials.
There's clearly a path forward. There's clearly an importance for both countries as well to find a solution to this. So, I think we heard clearly some of those irritants were. I think there's a path that we can make these kind of go away as well, though.
The U.S. has made its irritants known. The booze ban, supply management, and the Online Streaming Act high on the list, with one source today quoting frustration from U.S. officials who said dealing with Canada has been a roller coaster.
He seems to go and socialize and come back empty-handed while the Mexicans have been in formal negotiations, eating our lunch for the last 6 months. I am concerned that Mr. LeBlanc goes down at a time when Mark Carney has led us into the only recession in the G7.
The Prime Minister, meanwhile, tried to downplay the idea Mexico is further ahead in talks.
There's a series of issues, technical issues that they have with Mexico, they have with us, which is why there's a bifurcated discussion. So 30 issues or so with us, more than almost 60, I think, with Mexico at current count. And so we're working through a series of those issues.
Mexico has already wrapped up one round of trade talks with the U.S., with 2 more set, leaving many worried about where that leaves Canada ahead of a July 1st deadline. Abigail Beeman, CTV News, Washington.
That does it for the close today. Thanks for joining us. We'll see you tomorrow.